World markets, let's focus over there, have opened the second quarter of 2012 on a rather dismal note. The debt crisis in Europe continues to rage, with Spain now inching closer to needing a bailout. So how will equity markets fare this quarter? We've got Michael Houston, who's a market analyst at CMC Markets, who joins us on the show from London. Now, Michael, to begin with, Europe has had a rather choppy trading session this morning. What would you say the immediate concerns are for the markets?
Well, I don't think it's any secret that the immediate concern with respect to the market is what's happening in Europe right now. I mean, this morning Spain is currently debating its new austerity budget, and there's widespread scepticism that they'll be able to deliver on it. There's also the fact that across Europe, not only in peripheral Europe but also in core Europe, manufacturing activity is dropping back quite significantly, and there's also concerns about a hard landing in China, or even a soft landing in China. Now, we had some fairly good positive PMI data out of China earlier this week, but there was a slight contradiction in the official figures relative to the sort of unofficial figures that are brought out by HSBC. So I think there's still concerns about China going forward, severe concerns about Europe. The US economy and the UK economy seem to be diverging away slightly.
Now, Michael, as we go into the second quarter of 2012, do you believe the equity markets will be able to repeat their first quarter performance, especially in light of existing challenges that still remain in the Eurozone?
I think it's highly unlikely that equity markets will be able to post another 15 to 20% gain over the next quarter. I think they'll do well to hang on to the gains that they've made in the previous quarter, for the reasons that I just outlined. There are significant concerns going forward in Europe. We've got a Greek election in May, we've got a French election in May. There's a number of political hurdles that need to be overcome in Europe, and I also think it's highly unlikely that we'll get any extra liquidity either from the ECB or from the Federal Reserve, for that matter.
Now, Michael, for the Eurozone, where the very essence of its economies has been domestic consumption, how much of a challenge would you say a youth unemployment rate of 21.5% poses? Are we talking about European economies needing to rebalance in order to adjust to this new reality?
I think, talking about rebalancing the economy, it's a very easy thing to say. As Spain, Greece, Italy and Portugal are finding, it's a very, very difficult thing to do when you're basically tied into an exchange rate that's really more suited to Germany than it is to anybody else. Now, you talked about youth unemployment. I'm assuming that you mean the youth unemployment rate across the Eurozone as a whole. When you look at Spain and when you look at Greece, you've got youth unemployment nudging upwards of 50%. The current austerity measures that they're being forced to implement by the Troika and the EU aren't going to make that rate come down anytime soon. So there are enormous challenges that are facing these countries at the moment with respect to rebalancing their economies, and they've got to do it without one of the key anchors in doing that, and that's a devaluation, a currency devaluation, because they're inside the euro. So they're going to face a very, very tough time over the next few months and possibly years.
Right, now, Michael, just focusing on the equity markets, what sectors would you be betting on? Would you still be skeptical of bank stocks?
I'm still not buying into bank stocks. Obviously, there could be some more upside in there if somehow European leaders manage to come up with some form of solution that basically stops the economies in Spain, Italy, Greece and Portugal from imploding further. As I say, I think they're very high beta. I would certainly steer clear of them, given the fact that they're going to have to raise their Tier 1 capital ratios under European banking regulations by the middle of June. That means they're going to have to cut back on lending, and that could well impact their profitability. The sectors that I'm particularly looking at the moment are more defensive in nature. Probably technology as well. Suppliers to maybe Apple could be a good bet. I obviously won't name them, but you can guess who they are. So I'll certainly be looking at technology, maybe pharmaceuticals and telecoms as well.
A quick word then, Michael, on the outlook for commodity markets, and how worried would you be about the likelihood of oil prices rising further from current levels? Do you see that happening?
I think there's a risk of that, but I think the risk is mitigated somewhat by sort of demand concerns, certainly out of Europe, but I certainly don't see them falling back that significantly either. You've got the concerns about a flare-up in the Middle East. They're not going to go away. When you look at the Brent premium over WTI, it's around $20 at the moment. So I think what we really need to see with respect to oil prices, certainly with respect to Brent, is for the oil prices to try and basically get back below $120 a barrel. But I certainly don't see an awful lot of downside, given the fact that consumption in Asia is actually increasing, and that wasn't the case in previous recessions that we experienced here in Europe and the US.
Michael Hewson, many thanks for coming in on the show and walking us through the outlook for the Eurozone and indeed the equity markets as well.